I'm going to talk today a bit about what's happening in the U.S. Clearly, there's a lot of interest and curiosity both abroad as well as here about what is actually happening and when we're going to get a market and what is that market going to look like once it actually takes shape. So first we'll start with an update of where we are today. And where we are today is in order for legislation to pass in the U.S., we have to have bills that are approved or passed through both our House of Representatives as well as the Senate. And we have cleared the first part of that. So we've passed the bill in the House of Representatives. It's also called the Waxman-Markey bill, also known by a shortened name of the bill called ACES. And what is encapsulated in that bill is a 17% reduction below 2005 levels by 2020, roughly bringing us back in line with kind of 1990 level emissions by 2020. And then that reduction, so relatively modest, I think, when you look in comparison to the rest of the world target for 2020, but then ratcheting the target to an 83% reduction below 05 levels by 2050. It is a fairly large economy-wide bill. So it initially starts out covering about 66% of economy-wide GHG emissions in the U.S. and goes up to an 85% coverage. In terms of sectors that are not covered, so in the remaining 15% that is not under the cap, one primary component is agricultural and forestry sectors. They represent about 7% of U.S. emissions and are exempted from the cap. About 80% of the allowances are going to be allocated for free in the early years of the phase. This is a movement from what was originally proposed. The original proposal was close to 100% auctioning of the allowances, but not really all that surprisingly given political dynamics. There's been a move to both political dynamics as well as cost concerns. There's been a move to distribute the allowances for free to various covered entities, and then also, interestingly, to take a chunk of the allowances and distribute them to states, to regional tribal entities, to forestry. So there's kind of been a bit different from perhaps the allocation that was done in the EU, a bit more distribution of the allowances, not necessarily directly to covered entities, though some have gone directly to covered entities. Part of the concern, one of the concerns around free allocation, of course, was windfall profits, particularly in the utility sector, such as some of the concerns that had come out of the EU experience. And that has been addressed in the context of the electricity sector by having the allocation actually go to what are called the wires companies, or the distribution entities, which are regulated entities across the board. And then the generators would have to effectively purchase the allowances from the wires companies, but then they're able to recoup that cost when they charge the electricity back to the wires companies. So it ends up being a net zero, or in theory, a net zero for the freely allocated allowances in the electricity price. The free allocation does phase out after 2025, and gradually the percentage of allowances that are auctioned goes up, and with the goal that by 2031, 70% of the allowances are auctioned. This is a analysis of the caps and the trajectory of the targets in the bill that was put together by the World Resources Institute. It was updated in June of this year, just after Waxman-Markey was going up for the vote, or just actually as Waxman-Markey was going up for a vote in the House. And so you can see that Waxman-Markey is actually a fairly aggressive, a fairly solid bill in terms of its targets over the long run, and then but kind of with a bit of buffering potentially in the early years. In terms of the offset side of the picture, there's a big allowance for offsets, and offsets are envisioned to play a very significant role from the perspective of cost mitigation in the Waxman-Markey bill. Waxman-Markey allows 2 billion allowances total, will be on an annual basis, with a split between half and half equally between domestic and international allowances. Interestingly, another part of that is that if there are not enough allowances in either bucket, you can ratchet up the amount of allowances that could come from one of those buckets up to 1.5 billion allowances. Certainly some debate as to where that volume will come from, and that will be an interesting thing to see how that evolves over time. Actual use of offsets for compliance at the covered entity level is limited as a percentage of the total covered entity's compliance obligations, and so that is kind of replicating a little bit from the concepts of supplementary, if you will, that has been in part of the EU and international discussions. Early action offset projects, certain early action offset projects are being denoted as eligible to receive federally issued offsets for emissions reductions. And the language is really that if it's a state or regional or tribal approved program, then it would be able to come in as early action. And so in that vein, it's looking likely that the Climate Action Reserve, as well as I would say certainly likely that any offsets issued under the RGGI scheme would qualify. There's a larger degree of uncertainty about some of the voluntary market standards like the VCS or ACR and VCX. Will remain to be seen exactly how those might come in to qualify.